Kelly, thank you very much. Yes, I'm down here at the New York Stock Exchange. Tech stocks getting hammered here along with the broader market. The sector having its worst week of the year as trade fears put pressure on the group, along with some general profit taking, it would seem. Frank Cappelleri of Instinet and Mark Tepper of Strategic Wealth Partners are your Trading Nation team today. So, Frank, put this into context for us in terms of tech. It's obviously been really the leader steadily for some time right now, giving back a little more than the overall market. How does that set it up?
Mike, we're looking at the NDX. We know that it's down about 3% from Friday's high. And I think we have to put that in perspective because this is now the 7th decline of at least 2% since the start of the year. Average being 3.5% and the worst being 4.5% going down. And each one of those pullbacks eventually reversed. And the most important part about that is that those pullbacks produce what we call a bear trap, where there is bearish pattern form, downside break, and then a quick reversal higher. Each one of those reversals higher produced a new all-time high. So I think that's important to consider. You know they're going to get a bounce relatively soon. If that bounce does not produce a high here, that'll tell us that the character has changed. At that point, we'll probably get more bearish.
All right, so right now, still the possibility that it is another trap for the bears. Mark, how would you view it right now? Would you say, look, tech has basically carried us long enough. Maybe it's time to look elsewhere? Healthcare has been perking up, for example.
No, I wouldn't jump the gun here. I mean, tech has outperformed the broad market this year by like probably 9% or so. So a breather is okay. It's healthy. All you're seeing right now is a little bit of risk-off rotation after the tariff threats. And like you said, Mike, I mean, healthcare has gone pretty much straight up over the last 2 weeks. But we continue to like tech. We're overweight, but we would be selective. So we prefer software over semis right now. I mean, software is going to be less cyclical. And one of our favorites is Salesforce. They focus on making businesses more profitable and more efficient, all with recurring revenues, and you know that's probably one of the last expenses a business would cut in the event of a recession. So as long as the Fed is patient, the bull market stays intact, and I'd be adding to positions right now.
All right, software over semis to stay away from that China risk. That's one idea. Thanks a lot, Frank and Mark.
One mistake that many traders make is trying to pick the perfect entry price for a stock they'd like to own. Here's something to consider. Why not just buy part of the position you'd like to have? That way, if the stock goes down, you'll have an opportunity to add additional shares at a lower price and improve your overall cost basis. I'm Randy Frederick, and Schwab is the better place for traders.